In this video, we'll break down two hypergrowth AI stocks that could become some of the biggest winners of the next decade. These are not slow-moving legacy businesses trying to catch up to the AI boom. These are companies building the actual infrastructure powering the future of artificial intelligence, and demand for what they offer is exploding faster than almost anyone expected. Both companies are scaling at a pace rarely seen in public markets. They are securing billion-dollar contracts, expanding massive data center footprints across the United States and Europe, and positioning themselves at the center of one of the biggest technology shifts in modern history. And if AI demand keeps accelerating over the next 10 years, these businesses could become foundational pillars of the global digital economy. The first stock is Nebius, ticker symbol NBIS. Nebius is one of the most fascinating AI infrastructure stories in the market right now because it is attacking one of the biggest bottlenecks in artificial intelligence: compute power. Everybody talks about AI models. Everybody talks about chatbots and automation. But none of that works without massive amounts of GPU infrastructure running behind the scenes. Training and deploying advanced AI systems requires extraordinary computing capacity, and right now demand is completely overwhelming supply. That is exactly where Nebius comes in. Nebius operates in the rapidly growing neo-cloud space. Instead of being a traditional cloud provider serving every possible workload, Nebius focuses specifically on AI infrastructure. Its entire business is optimized for companies that need high-performance computing power for training and running AI models. And this specialization matters a lot. One of the reasons Nebius has been gaining traction so quickly is because enterprises do not just want generic cloud services anymore. AI workloads are extremely demanding. They require dense GPU clusters, low-latency networking, advanced cooling systems, and infrastructure specifically designed for machine learning applications. Nebius is building its platform around those exact needs. That makes the company incredibly attractive to businesses racing to deploy AI at scale. The market is starting to realize how big this opportunity really is. In its most recent quarter, Nebius reported revenue growth of an astonishing 684% year-over-year, with quarterly revenue reaching nearly $400 million. That is not normal growth. That is hypergrowth at a level rarely sustained in public markets. And what makes the story even more compelling is that management believes this is only the beginning. The company expects its annualized revenue run rate to climb from roughly $1.25 billion at the end of 2025 to somewhere between $7 billion and $9 billion by the end of 2026, as additional data center capacity comes online. Think about what that means for a second. That is not a company hoping growth improves someday in the future. That is a company actively building the infrastructure needed to support demand that already exists today. And the scale of that expansion is enormous. Nebius is aggressively increasing its data center footprint and contracted power capacity because AI customers are desperate for compute resources. The company recently expanded its large-scale infrastructure plans even further, including a massive Pennsylvania data center project that significantly boosts its future capacity. This is one of the most important things investors need to understand about the AI infrastructure market right now. Demand is not theoretical anymore. The biggest technology companies in the world are spending aggressively because they cannot afford to fall behind in AI. And even the hyperscalers building their own data centers still need outside partners because demand is moving faster than they can build internally. That creates a massive opportunity for companies like Nebius. And unlike some speculative AI businesses that still have unclear monetization models, Nebius is providing something very tangible and very necessary: compute infrastructure. This is the digital equivalent of selling shovels during a gold rush. Another reason the company stands out is its vertically integrated approach. Nebius is not just renting random server space and hoping for the best. The company designs much of its infrastructure internally and owns a significant portion of its capacity, which gives it more operational control and flexibility over time. That matters because AI infrastructure is becoming increasingly strategic. Companies that can efficiently deploy GPUs, optimize power consumption, and scale quickly could develop significant competitive advantages over the next decade. Nebius is trying to position itself as one of those long-term winners. The market clearly sees the potential. The stock has experienced explosive momentum as investors begin pricing in the possibility that Nebius becomes one of the dominant AI infrastructure providers globally. Its market capitalization has climbed rapidly alongside the company's growth trajectory. But here is what makes this story especially interesting. Nebius is still relatively early in its growth cycle compared to what the AI market could look like 10 years from now. We are still in the very early innings of enterprise AI adoption. Most industries have barely begun integrating advanced AI systems into their operations. Healthcare, finance, logistics, cybersecurity, entertainment, manufacturing, and education are all moving toward increasingly AI-driven workflows, and every one of those trends requires more compute infrastructure, more models, more inference, more training, more GPU demand. That demand cycle could last for years. One thing investors should also pay attention to is the quality of Nebius's customer relationships. The company has secured partnerships and agreements tied to some of the biggest players in the technology industry, including large-scale AI infrastructure deals connected to major hyperscaler demand. When large enterprise clients commit to long-term AI infrastructure spending, it creates stronger visibility into future revenue growth. That is one reason why investors are becoming increasingly bullish on the neo-cloud sector overall. Another important factor is the support Nebius has attracted from the broader AI ecosystem. NVIDIA has been connected strategically to both Nebius and other neocloud providers because NVIDIA understands better than almost anyone where AI demand is heading. That should not be ignored. NVIDIA's entire business depends on accelerating AI infrastructure demand. So when NVIDIA aligns itself with companies operating in this space, it signals confidence that these businesses may play a major role in the future AI economy. Of course, Nebius is not without risk. And this is where investors need to stay realistic. Building AI infrastructure at scale is extremely capital-intensive. Data centers require billions of dollars in investment. GPUs are expensive. Power requirements are massive. Expansion requires enormous financing. Nebius is spending aggressively because management sees a once-in-a-generation opportunity, but rapid expansion also introduces financial risk. This is not the kind of stock investors buy expecting smooth, stable returns every quarter. Volatility will likely remain very high. The stock could experience major swings based on AI spending trends, financing conditions, macroeconomic uncertainty, and execution risks tied to expansion. But for long-term investors willing to tolerate volatility, the upside potential is enormous if Nebius successfully scales into a dominant AI infrastructure provider, because the total addressable market here is gigantic. Artificial intelligence is becoming one of the defining technological revolutions of the modern era. And while many investors focus entirely on consumer AI applications, the infrastructure layer supporting the entire ecosystem may ultimately become just as valuable. Without compute infrastructure, none of the AI revolution functions. No large language models, no enterprise AI deployment, no generative AI services, no AI-driven automation. Infrastructure is the foundation underneath all of it, and Nebius is positioning itself directly at the center of that foundation. There is also another important reason why the long-term opportunity may be bigger than many investors realize. Inference demand. A lot of people focus only on training AI models, but inference could become an even larger long-term market. Once AI systems are deployed across industries, they constantly require computing power every time users interact with them. That creates recurring infrastructure demand, and if AI adoption spreads globally across businesses and consumers over the next decade, demand for inference compute could become enormous. That creates a potential long-duration growth runway for companies like Nebius. Another thing working in Nebius's favor is timing. The company is scaling during a period when governments, enterprises, and investors are prioritizing AI development aggressively. Capital continues pouring into the space because companies fear missing the next wave of technological transformation. And when fear of missing out combines with genuine demand growth, infrastructure providers often benefit tremendously. We have already seen signs of this across the broader AI ecosystem. Companies are signing multi-year agreements because they need guaranteed access to compute capacity. That gives infrastructure providers stronger long-term visibility than many traditional technology businesses. Still, investors should understand that this is not a low-risk investment. Competition in AI infrastructure will intensify over time. Large hyperscalers are expanding aggressively. New entrants are emerging. Pricing pressure could eventually increase. And if AI spending slows unexpectedly, highly leveraged infrastructure companies could face significant challenges. Those risks are real. But so is the opportunity. And right now, Nebius appears to be executing extremely well during one of the most important technology build-outs in decades. The combination of triple-digit growth, expanding infrastructure capacity, rising enterprise demand, and long-term AI adoption trends creates a very compelling investment narrative. If the company successfully scales over the next several years, investors looking back 10 years from now may view today's stage as only the beginning of Nebius's growth story. And honestly, this is why so many investors are paying close attention to the neocloud space right now. These companies are not simply riding temporary hype, they are building the infrastructure layer for artificial intelligence itself. That is a much bigger story. If this resonates with you, you're exactly who this channel is for. Please hit the like button, share the video, and leave your thoughts in the comments. Subscribe to the channel so you don't miss out on the next important financial investing update. Remember to do your own research before you invest in any stock. The second hypergrowth AI stock that could potentially become a massive long-term winner over the next decade is CoreWeave, ticker symbol CRWV. CoreWeave is one of the most talked about companies in the AI infrastructure market right now, and for good reason. This company sits directly at the center of one of the most important trends happening in technology today, the global race for AI compute power. What makes CoreWeave so fascinating is that it was built specifically for high-performance AI workloads from the ground up. This is not a legacy cloud business trying to retrofit its infrastructure for artificial intelligence after the fact. CoreWeave focused aggressively on GPU-accelerated computing early, and that strategic positioning is now paying off in a very big way. The demand environment surrounding the company is extraordinary. Artificial intelligence models continue getting larger, more complex, and more expensive to run. Enterprises are scaling AI deployments faster than expected, startups are racing to build next-generation applications, and major technology firms are spending billions to secure access to advanced GPU infrastructure. That has created one of the biggest supply and demand imbalances in modern technology infrastructure, and CoreWeave is benefiting enormously from it. One of the biggest reasons investors are so bullish on CoreWeave is the sheer scale of its revenue growth trajectory. The company has been securing enormous AI infrastructure contracts at a pace that has shocked Wall Street. Revenue growth has accelerated dramatically as demand for GPU cloud services continues exploding across the industry. And this growth is being fueled by long-term contractual agreements tied directly to AI compute demand. That matters because visibility is incredibly important for infrastructure businesses. When customers commit to large-scale multi-year agreements, it gives investors stronger confidence that future demand is durable rather than temporary. CoreWeave has become one of the clearest examples of that trend in the market. Another major factor driving investor excitement is the company's close alignment with the broader AI ecosystem. CoreWeave built a strong relationship around NVIDIA GPU infrastructure early, which helped position the company as an attractive provider for businesses requiring high-performance AI compute environments. And this is important because advanced GPUs are essentially the fuel powering modern artificial intelligence. Without them, advanced model training and inference become impossible at scale. CoreWeave recognized this trend before much of the market fully appreciated how large AI infrastructure demand could become. Now the company is rapidly expanding to meet that demand. The scale of expansion happening right now is enormous. CoreWeave continues investing aggressively into additional data center capacity because customer demand keeps increasing. The company recently secured billions in financing tied directly to infrastructure expansion initiatives, allowing it to continue scaling GPU deployments aggressively. This is one of the defining characteristics of the current AI infrastructure boom. The companies winning today are the ones capable of deploying capacity quickly enough to meet surging enterprise demand. And right now, speed matters tremendously. Businesses developing AI systems cannot afford to wait years for compute availability. They need infrastructure now. That urgency creates a huge opportunity for companies already operating at scale. CoreWeave is positioning itself as one of those critical providers. Another major reason why the long-term opportunity could be substantial is the company's exposure to both AI training and inference workloads. Training large AI models requires massive GPU clusters running for extended periods. But once those models are deployed into real-world applications, inference demand begins growing as millions of users interact with those systems daily. That creates recurring demand for AI compute infrastructure. And if artificial intelligence becomes deeply integrated into business operations over the next decade, inference demand alone could become an enormous long-term revenue driver. This is why many investors believe AI infrastructure spending may remain elevated for years rather than quarters. The entire global economy is gradually shifting toward AI-enhanced workflows. Customer service systems, software development, cybersecurity, healthcare diagnostics, financial analysis, manufacturing optimization, digital advertising, content generation. Every one of these areas increasingly depends on AI compute power. And infrastructure providers like CoreWeave sit directly underneath that entire ecosystem. That positioning creates tremendous long-term relevance. One thing that makes CoreWeave especially interesting compared to traditional cloud providers is its specialization. AI workloads are very different from standard enterprise computing tasks. They require optimized networking, extremely fast data transfer, advanced GPU orchestration, and infrastructure environments specifically designed for machine learning performance. CoreWeave built its business around those exact requirements. That specialization could potentially create a durable competitive advantage as AI adoption accelerates. Because customers are not just buying generic cloud storage anymore. They are buying performance. They are buying speed. They are buying scalable AI compute capacity that can support increasingly demanding workloads, and right now, supply remains constrained relative to demand. Another important detail investors should pay attention to is the broader market environment surrounding AI infrastructure. Capital spending tied to artificial intelligence has accelerated dramatically across the technology industry. Enterprises are increasing AI budgets aggressively because leadership teams understand that falling behind in AI adoption could create long-term competitive disadvantages. That creates a powerful secular tailwind for infrastructure providers. The AI race is no longer optional for many businesses. It is becoming a strategic necessity, and when industries enter these types of transformational cycles, infrastructure providers often become some of the biggest long-term winners. We saw similar patterns during previous technology revolutions. The businesses providing foundational infrastructure frequently captured enormous value over time because they benefited regardless of which applications ultimately dominated. That dynamic may play out again in artificial intelligence. Of course, investors also need to understand the risks. CoreWeave operates in an extremely capital-intensive industry. Scaling AI infrastructure requires massive investment. Data centers are expensive. Power requirements are enormous. GPU hardware costs billions, and maintaining rapid expansion often requires substantial debt financing or additional capital raises. CoreWeave has been aggressively securing financing because management clearly sees enormous demand opportunities ahead, but rapid scaling also creates execution risk. If demand growth slows unexpectedly, or if pricing pressure increases over time, infrastructure businesses carrying heavy expansion costs could face volatility. Competition is also likely to intensify. The AI infrastructure market is attracting huge amounts of investment because the opportunity is so large. Larger cloud providers continue expanding their AI offerings aggressively, and new entrants will continue emerging as the market evolves. That means execution matters tremendously. Companies that deploy infrastructure efficiently, maintain strong customer relationships, and scale intelligently may separate themselves over the next decade. Right now, CoreWeave appears to be executing aggressively during a period of unprecedented AI demand growth, and investors are rewarding that growth story. What makes the stock especially compelling for long-term investors is the possibility that artificial intelligence spending remains structurally elevated for many years. This may not be a short-lived trend. AI could become one of the defining technological shifts of the 21st century, and if that happens, demand for AI infrastructure could continue compounding for a very long time. That is the core investment thesis here. CoreWeave is not simply benefiting from temporary excitement surrounding AI headlines. The company is helping provide the infrastructure layer required to power the broader AI economy itself. That distinction matters, because while consumer AI applications may change rapidly over time, the need for compute infrastructure could remain durable across multiple technology cycles, and that creates the potential for sustained long-term growth. Another thing investors should consider is how early we still are in enterprise AI adoption. Many businesses are still experimenting with AI integration. Large-scale deployment across entire industries remains in relatively early stages. If adoption accelerates over the next decade the way many analysts expect, demand for GPU infrastructure could become dramatically larger than current levels. That creates a very large potential runway for companies positioned correctly today, and CoreWeave clearly intends to scale aggressively into that opportunity. One reason this stock continues attracting so much attention is because investors are trying to identify the infrastructure companies that may become foundational players in the AI economy 10 years from now. Not every company will survive this race. Some businesses will overexpand, some will struggle operationally, some may fail to maintain pricing power. But the companies that successfully scale could become incredibly valuable over time. That is why investors are willing to tolerate volatility in names like CoreWeave. The upside scenario is massive if AI infrastructure demand continues compounding globally, and the current market environment suggests that demand remains extremely strong. At the end of the day, what makes both CoreWeave and Nebius so interesting is that they are not just participating in the AI trend at the application layer, they are helping build the underlying infrastructure that powers artificial intelligence itself. And historically, infrastructure businesses supporting transformational technology shifts have often created enormous shareholder value over long periods of time. That does not guarantee success, but it does explain why investors are paying such close attention to this space right now. Because if artificial intelligence truly transforms the global economy over the next decade, companies supplying the compute power behind that transformation could become some of the biggest winners of the entire cycle. This video is brought to you by Value Stocks Investing Master Course. If you're looking to grow your wealth by investing in solid, undervalued stocks but not sure where to start, I created the Value Stocks Investing Master Course to teach you how to identify great companies, make smart investment decisions, and build a portfolio that lasts. Click the link in the description and pinned comments to get the course today and take control of your financial future. If you want exclusive stock tips, in-depth analysis, real-time trade alerts, and free investing guides, join the Stocks Galore Patreon today and take your investing game to the next level. Our members get full in-depth analysis on most of the stocks mentioned here. Head over to patreon.com/stocksgalore and become part of our growing community of smart investors. Link is in the description. Now here's the big question for you. Which company do you think has the stronger long-term advantage in the AI infrastructure race? Nebius with its rapidly expanding NeoCloud platform, or CoreWeave with its aggressive GPU infrastructure scaling and enterprise partnerships? Let me know your thoughts in the comments below. Do not forget to like the video, share your thoughts in the comments, and subscribe so you do not miss the next important investing update. Thanks for watching, and I will see you in the next one.